Just how many companies are going to get caught in this downdraft, and how long does it last?
Emily, it's been pretty ugly, but we are almost at the end of earnings season here. And your team has done a great job of reporting a lot of the bad numbers out there. E-commerce has had its first negative quarter year over year in just about as far back as most folks can remember. Even in the first half of 2020, e-commerce was still up over the last year. And that has a lot of repercussions to other industries, software, ride sharing, advertising. But with these sell-offs, to be frank, we think there's something bigger going on here. And we think investors are reevaluating whether or not these are actually technology companies with limitless scale and low operating costs. Well, you have Netflix is now being valued like a cable station. Other investors are looking at Facebook's, Meta's capital intensity and saying, does their future look more like AT&T's than it does Google? And you've seen multiples re-rate faster than we've seen in a really long time across these assets, because investors now, in our opinion, they've likely moved too far in that direction. But we've got to do our jobs and parse through it and find the good deals here.
Meantime, you've had a flood of retail investors coming into this market over the last couple of years, thanks to companies like Robinhood. What happens to them?
Well, a lot of them might not exist. You saw something very similar in the late 90s internet boom. If you remember the explosion of the E-Trades and the Ameritrades, and a lot of those businesses ultimately had to merge to stay alive. Some went out of business, some went private. And this Twitter deal very well could be the first big transaction that we're seeing, but far from the last. So we expect a lot of consolidation. We expect some shutdowns. We expect the IPO window to remain pretty darn shut. So we don't think over the next 12 months, you're more likely to see a shrink in the total number of companies available for investment than you are to see new companies available for investment.
Where do you expect to see consolidation? Who do you expect to see shut down?
Well, the worse the business model, the more likely the consolidation. So you've had a lot of the ride-sharing folks on here in the last 24 hours. That space is just desperate for continued consolidation. Just Eat Takeaway and DoorDash have been big consolidators. Uber's tried to be, now they're divesting. So we think that space is just going to continually have to do deals amongst itself until they get to a small enough number of players to be profitable. What's more challenging?
So are you saying like Uber should buy Lyft?
Oh, I mean, have you ever seen two businesses more in need of a merger? But the ride-sharing space is really challenging because they're competing for the same thing ultimately, which is they thought these. I was in San Francisco with you for the last 10 years while these businesses were quickly being built up, and they were parading themselves as these complicated, fast-growing software platforms, and they were treating humans like commodities. And if we've learned anything over the past few years here, humans are actually a very precious input cost into the functioning of these businesses. And those business models are more dependent on humans than just about any business you've seen come out of Silicon Valley in the last decade. And that is a really competitive place to be. And it's a really hard place for investors to sit around and be patient for them to find ways of scaling those business models.
So how long does this drag out? How long are we in the red here?
Well, Amazon told us that starting on May 15th, growth rates relative to last year would start to look better and better. And we tend to believe them. If you remember last year, the first half was incredibly strong. The fastest growth you've seen in the US in the last 50 years. The second half, totally different story. One of the worst holiday seasons that the US has experienced in 20 years. So the comps relative to last year are going to keep improving. That likely, investors tend to have existential crises when growth rates are slowing down and management teams are surprised at how poorly their businesses are performing. But it's going to get a lot easier as the year goes on. And it's very possible that as you see some of these growth rates start to stabilize relative to last year's numbers, you might see some of these multiples come back to more middling ranges.